That's great. Thank you, Sean. I hope to live up to the big intro. As you were talking, I was thinking I'd love to meet that fella. He sounds great. I'd love to meet him. So I'd like to extend a warm welcome to all our SEMA guests and our ADM guests. And just to say at the outset, if like me you're not naturally an early morning person, I'd like to acknowledge the extra effort that you've taken to be here so early this morning. So my plan here this morning is just to run through a few real-life case studies so you maybe get an idea of what comes across my desk on a daily basis. So I hope you'll see some aspects of your own financial situation in some of these cases, but just, a little caveat, don't assume that you can just take some of these ideas, because some of them are quite general, so they're not there for you just to take and run with them, because everyone's situation will be different. Okay, so we'll just get into the first slide that we have here, so our first case study. So this is just to do with Teddy. So Teddy would be an employee, okay, as opposed to an employer. So he's an employee, and in short, he's got some excess personal monies, not too sure what to do with it. So just a couple of, broad brush strokes on this. So he's aged in his early 50s, he's married, he's 4 children. He's an active member of his employer's pension scheme. He contributes 5%, his employer contributes 5%. He's 300,000 in an ex-employer's pension scheme, and he's planning to transfer that currently into his employer's pension scheme. He's a small-ish variable rate home mortgage of 50,000. He's 200,000 on deposit that he doesn't need. He's frustrated with low interest rates and dark to 39%. So he's come into me seeking advice, and as he sees it before he's come into me, he believes he's kind of two choices. One is to buy an investment property, and the other would be to buy an investment bond from his local bank or life company. So I'll probably confuse Teddy straight away, because I'll advise him to do neither of those two things. And just for a couple of reasons. One is structure. Neither of those two ideas have a tax-efficient structure. When we're looking at buying an investment property, he can expect to lose half his rental income and taxes between income taxes, PRSI and USC. And when we come to the investment bond, the story isn't a whole pile better. He will lose 41% of any growth via exit tax when he goes to encash his bond. And if he leaves his bond untouched after 8 years, there's a deemed encashment where the life company or bank are obliged to go in and effectively, I suppose, raise his fund, take 41% of the growth and pass it on to the revenue commissioners. Also, aside from structure, particularly with the investment property, I'd have issues around the investment strategy. As you may have heard me say before, there's in broad terms, there's 5 places where your money can be, and this applies to everyone in the room, whether it's money inside a pension or outside a pension. And we call those the 5 asset classes. So that's cash, bonds, equities, property, and alternatives. So when someone picks, say, an investment property, what they're doing is they're picking one asset class and ignoring the other 4, and then they're picking one tiny geographical region, Ireland, and ignoring the rest of the globe. So we don't have to go too far back in time to recall that Irish bank shares and Irish property gave many people a harsh and costly lesson on the dangers of specific risk. So what sort of ideas would I be saying to Teddy? So in terms of the structure, the first thing I'd be saying to him is, let's have a look at ADCs to his pension fund. And this is quite timely, because a lot of us in the room will be receiving P60s round about now. Some people don't even look at them, but on there, when you look at the amount of income tax that's paid, for a lot of people there is a way to claim some of that back very quickly. So for instance, in Teddy's situation, assuming 100,000 salary, he's allowed to put in 25,000 as an AVC. It's a simple enough calculation. Someone in their early 50s is allowed to put in 30%. We take off his employee contribution in his pension scheme, but we can ignore the employer contribution for this calculation. So that's where we get that and I would have a lot of people this time of year who would come in to me, they come in with a P60 and their payslip, their last payslip of December 2016. Because from this I can get all that information, like what is their salary, how much employee contributions have they paid, and it is a simple enough calculation. So they do something with me called an AVC PRSA. And then it's quite easy to kind of claim their tax back. For most employees who don't have any other kind of income outside of their employment, we would just send off their P60 along with a policy document once it's issued and a short letter to the revenue. While he's at it, given the amount of money he has, he could go ahead and do another 25,000 now as a 2017 contribution, and he could wait until the start of next year to claim that. So that would be 50,000 for Teddy. His wife was in a similar situation, so that would be another 50,000. So now we're looking at 100,000. He'll get 40% income tax relief on the amount, so he'll get 40,000 of that back. Tax-free growth in the entire fund, as long as it's there as long as it's pre-retirement and he hasn't drawn on it. And then should he be unlucky enough to join pre-retirement, the full fund value gets paid out tax-free to his spouse. The next idea I'd look at would be child savings plans. Like Teddy was planning to save for his children's education anyway, so why not do this in a situation where there is some tax advantage? So the idea here would be to utilise the annual small gift exemption of 3,000. So for instance, Teddy and his wife could give 6,000 to each of their 4 children. So we would do that via child savings plan. There would be a one-page document that's very important. There would be a deed of assignment, and that's the means that beneficial ownership would be transferred from parent to child. And you could do 24,000 in 2017, and in 2018 you could do another 24,000 and keep doing that thereafter annually. So what we're looking at there is he's 50,000 left of his 200. I would actually suggest that he just repays his variable rate mortgage, because if you look at typical variable rate mortgage at the moment is about 4% or 4.1. So if you look at how much you'd need to get in an investment bond to just make that return, you'd be looking at actually about 8% return, less your 1% annual management charge, less your 41% exit tax, would bring you back to the 4% mortgage rate that he's paying. So that's what I would do there with Teddy. So other points, I would say to him to not transfer the 300,000 from his ex-employer scheme to his new employer scheme. I would suggest to him that he transfers that into a buyout bond. So for instance, that would give him a couple of advantages. One would be flexibility. He could now draw on this buyout bond. He's over 50, so he could draw on this buyout bond now at any stage he wants. Whereas if he was to transfer that into his new employer scheme, he wouldn't be able to do that. And second, if he is to join, we know that the buyout bond will be paid out fully tax-free, but there are some rules around group pension schemes that limit the amount to be paid out tax-free. So now we have Teddy on course. He was already putting in his 5% and his employer putting in the 5%. And now with his ABCs, we have him putting in 35,000 a year for 9 years, because he said, I hear a lot of people say to me, I think I can only stay in my current job 60 max. For some people it's so busy. So what would it look like if he tried to retire at 60? So he had 300,000 now, 35,000 per year for 9 years. If we assume 4% investment growth, and then we'll be looking at a pension fund of 800,000. So what does that pension fund look like? So when he comes to 60, I know it's time to mature his pension fund. 800,000. What would happen is he would most likely choose to take 25% of that tax-free, which is the optimum tax-free lump sum, because he'll get every cent of that 200,000 tax-free immediately. He'll put the next 63,500 into an AMRF, with the balance of about 536,000 into an ARF. So with his ARF, when he's in his 60s, he will be obliged to draw down 4% of that sum. So that comes in at about 21,000 or so. That will be subject to PAYE, PRSI and USC. Now PRSI will disappear when he's 66, but the other two will remain. And just I suppose to mention at that level at 21,000 or so, he's well within his 20% tax band, so he may even choose to draw down more money from his ARF as long as he's only paying 20% income tax, and stop when he gets to a point when he'd be looking at paying 40%. So then the next example that I have is Tommy. So Tommy is the employer, okay? So he may very well even be the employer of the first case. So what we're looking at here is an employer who has excess monies also, but they're not in his personal current account. They're in the company, they're in the limited company bank account. So Tommy is married to Mary. Both are company directors aged in their mid-40s, a very profitable limited company. With his year end the 28th of February. So his year end is coming up next week. He comes into me today and he says to me, I've got about 240,000 surplus to requirements in the limited company bank account. What should he do? So if he does nothing and leaves the money sit there, he will suffer corporation tax on it, most likely close company surcharge. Should he decide to take it out as salary, he's going to suffer up to 55% personal taxes, with his 40% income tax, with 4% PRSI, and he'll be into the 10% USC bracket. So I would be suggesting to Tommy that he transfers this out to his own pension fund, to himself and his wife's pension fund, to use that tax-efficient pension structure. So I would be saying that he transfers this out as employer-paid contributions, okay, as opposed to employee contributions. In terms of the structure, we already would have faced this when we set up this policy. We would have had a choice between an executive pension, a personal pension, or a PRSA. So we would have chosen an executive pension over the other two for reasons of funding ability and tax efficiency. So with regard to funding ability, employee contributions are a percentage of someone's salary, as we saw in the last example, but employer contributions is a totally different set of rules and many times can actually be a multiple of a person's salary. We would prefer employer contributions to employee contributions. We saw with employee contributions that he will save the income tax, but with employer contributions you're effectively also saving on the PRSI and the USC when you're comparing it to taking that money as salary. So, given sufficient salary and service, that just means given that his P60 amount is high enough and he's done a number of years service with his company, we're in a situation there with a full 240,000, as in 120,000 transfer to each director's pension fund can just be taken out in one go out of the limited company bank account today and put into their pension funds. Now they will get corporation tax relief on this, and it's just to mention that normally on large amounts corporation tax relief can be spread forward up to 5 years, but a little kind of trick of the trade that I would always look at is that he was already putting in about 5,000 a month, so because business is going so well he can afford to up this to 10,000 a month. So by kicking that off in February, which is still just before his year end, his ordinary annual contribution is now deemed to be 10,000 a month. So 12 months by 10 is 120,000. Same for his wife. That allows us to put into 240 and have it fully allowable as a corporation expense in this year end in full, just coming up in a few days' time. So then, just to have a look, as we can see, Tommy and his wife would be, at that level of funding, would be well on target to get to 2 million, which would be the limit, the upper limit on pension funds. And just have a look at what 2 million might look at as a pension fund. So 25% as your tax lump. So that's 25% of 2 million is 500,000. So the first 200,000 of that is tax free, and the next 300,000 is at 20% tax only. So that means he would lose 20% of the 300,000, so he'd lose 60,000 in tax, and he'd have 440,000 immediately. The next 63,500 he's obliged to put into an AMRF, with the balance of about 1.44 million goes into this ARF. So again, he's obliged to take down a 4% drawdown each year when he's in his 60s. So we'll be looking at a number there of about 57,000 or so. Then, just to mention, with the executive pensions that Tommy and his wife had, they're individual schemes, so there's a lot of flexibility with them. And I've actually even had company directors who are members of their own group scheme, so they were a member just like all their employees. And some of them have actually chosen to come out of the group scheme and set up their own individual executive pension scheme. And just some of the reasons, one would be to do with your normal retirement age. We might start off, typically in most people's pension scheme, there's a normal retirement age of 65, and it's set by your employer and it applies to the group as a whole. When you have your own individual scheme, you could start off with any normal retirement age you want, say 65, but you can actually amend that and change that later as your circumstances change. So for instance, Mary might be in a situation where she doesn't need to draw on that pension fund at all. So she might actually push her normal retirement age up to 70 and just leave her funds sit there. And she was wary of the fact that she knew when she drew in her fund she would have to take some monies of 4% or so of the ARF, which is taxable income, and she didn't need to take it and didn't want to pay the tax. Tommy, on the other hand, might be more of a spender, and he might say, actually, I'd like to get at that money early. So Tommy might move his NRA to 60. So all that happens is one day, when Tommy wakes up and it's his 60th birthday, he goes into his company like he always did, except now, just because he's 60, he'll outdraw his pension fund. If Tommy said, can I get at this money earlier, access is possible from age 50, okay, but normally it would be subject to Tommy leaving the company. He'd actually get a P45, and sever all his ties with the company, which generally means that he'd sell his shareholding. I have actually seen other directors, these are all the ideas of flexibility. The last one I just saw was a company director who had a large fund. He was in his mid-50s, about $1.5 million in his fund, and he knew that if he died while an active member of the pension scheme, there was rules as to how much money could be paid out tax-free, which was generally 4 times your salary and the value of your employee contributions. But he knew that he wasn't kind of happy about that, so he knew that other pensions you could get a tax-free payout on debt. So what we did was we actually wound up as individual one-person scheme, transferred it to a buyout bond, which created a preserved benefit under the Pension Acts, which meant now that if, say, Tommy in this situation, if he was to die pre-retirement, before drawing on that, the full amount would be paid out tax-free to a spouse. Okay, so just to look at the retirement planning or pensions, the 6 key tax benefits. So the first one, well, we mentioned, I'd say practically all of these actually. Employee contributions, 40% relief. Employer contributions, in addition to the 40% income tax, we're also on target to save on PRSI and USC. Tax-free investment growth on the entire pension fund, which doesn't actually get mentioned enough. That's worth a lot of money. Tax-free lump sums, first 200,000 will be tax-free, and for someone with, say, that 2 million fund, any additional amount, say 300,000 in their case, will be taxed at 20% only. We've had a look at debt before retirement, how in buyout bonds, personal pension plans and PRSAs, the full fund will be paid out tax-free. And we've also mentioned under occupational pension schemes, which would be group pension schemes, and executive pension scheme, that the tax-free payout would be limited to 4 times salary and value of employee contributions. The ARF itself, which is a post-retirement pension, is what I would call that. In your 60s, you'd be drawing down 4% of that at a minimum. You may decide to draw down more should it suit you. And also just to mention on the ARF, if the husband, say, for instance, dies, the wife just steps into the shoes of the ARF holder and takes that over, and when the wife dies, that ARF is passed on to children. Now, the tax situation on that depends on whether the children are under 21 or over 21, and they'll pay either 30% or 33% of the balance of the ARF, and then the money is theirs. Okay. So then, just the third one, just to mention, similar to the details before to Teddy, with just one change. Instead of 200,000 in personal monies, there's a whopping 2 million in there, right? So, what will we look at there? So the first thing I'm going to say, which I probably should have said earlier, is that you would need to seek professional advice with Brendan as tax advisor here, who is probably listening to me, listening to my general statements on tax. I would certainly say that Dennis in the detail here, and Brendan knows more detail than I'll ever know. So certainly when we get to this stage, you would need a tax advisor and indeed a solicitor involved. So some of the high-level points, okay, that I might suggest to Teddy is we could consider owning securities directly. So with that 2 million, rather than buy units in a unit fund like an investment bond or so, we might be better off for Teddy to own those securities directly, so his name is kind of on, he has the shares himself. So some ideas there is that we could have, if there was a non-earning spouse, you may have an idea to put some of the share ownership in the non-earning spouse to use up their standard rate cut-off point. Debt does not trigger a capital gain, which is a big benefit for owning securities directly versus investment bonds, and also making use of losses forward. If, for instance, Teddy was unlucky enough to have had bought Irish bank shares, he'd obviously be down a lot of money. So this would be a way where he can use those losses forward against any future gains. Now, I have said capital gains tax losses can be complicated, and they are complicated, and you would need somebody there like Brendan to make sure that we get this working to the most optimal way that we can. Also, we'll be mentioning in this case, when we're talking about, say, 2 million, of course, we'll be bringing up CAT, capital acquisitions tax thresholds, very early. And just to mention that from parent to child, you could gift up to 310,000 before hitting tax at 33%. For other blood relations, it would be 32,500, and for anyone else, we'd be looking at about 16,000. Just to mention family partnerships, they were mentioned in a previous breakfast in detail. So I'm just going to mention them just that they're noted, and that they could be used as a way for parents to gift that 310,000, and indeed the ongoing amount each year, the small gift exemption, And just the idea here is that these gifts are subject to the legal structure of a partnership agreement with perhaps a parent as a managing partner. So even though they're gifting the asset, they retain control over how it's used. Also, just to mention Section 73 gift tax insurance. This was mentioned in the previous breakfast also. And just it's more widely known as the Section 72 concept, which is life insurance that is used to pay inheritance tax. So Section 73 is a similar enough concept where you have a savings policy that can be used to pay gift tax. So in other words, this savings policy itself, when it pays the gift tax, is not deemed to be the gift itself. Plenty of rules around it. So some of the ideas is that the savings plan does need to last for 8 years, and when you do in cash the savings policy, you do need to use it within 1 year to pay any gift tax liabilities. Also, just to mention, interestingly, when at the point of inception, it must be expressly taken out for Section 73, but there's no requirement to actually later use the money to pay gift tax. So it's like you take a policy out and you have the option but not the obligation to use that to pay gift tax down the road. So it is quite flexible. So for instance, somebody might isolate a portion of their investment, say either 500,000, and say they're going to use this Section 73 idea. So over the course of 8 years, they could actually transfer the proceeds into the Section 73 policy, and then they may choose to use that to pay gift tax down the road. So it's not as popular as it should be. I think it's not very well known, and I think as well some people may have had a bad investment experience, may have had a narrow investment strategy, and that may not have worked out for them. So then, just to sum up here, this is just my last slide, and it's just a 2-word: structure and strategy. Okay, so I spent my whole time here really talking about structure. So we've looked at pensions, the likes of executive pension schemes, personal pensions, PRSAs, buyout bonds. I've mentioned child savings plans and how we can use a small gift exemption. And then I mentioned how we need the help of others when the level of complexity increases, and we're looking at investments, maybe directly owned securities versus investment bonds, family partnerships, and Section 73 plans. So, as I mentioned a few times, you need someone Brendan involved on the structure. When it comes to investment strategy, I'm delighted Richard is here to speak on that, because it means I don't have to. Investment strategy for me, even though I spent the whole time speaking about structure, investment strategy is actually the starting point when I meet a client. So one of the things we do is a risk assessment questionnaire, which will give me an idea of their attitude to risk. And then also we do a detailed fact find, and that will give me details on their capacity to take risk. So then once I have those, we have an idea of their asset allocation strategy, and we can marry that to the correct structure. So maybe if you have the stamina, some other time I'll go through the strategy piece a bit more from my point of view. But for now, I'll just thank you for your attention and hand you back to Sean.